Hello and namaste. This is Neeraj here and welcome back to my channel Financial Market Analysis Twist by 𝗦𝗧𝗢𝗢. So in today's video I want to discuss something regarding the economy and this market overall in the world in the year going ahead post this Russia-Ukraine conflict. So just to a reminder, if you have not yet subscribed to my channel, you request you to subscribe so that you can keep getting unique and interesting concepts and ideas, and also the unique analysis. And also a disclaimer before starting this, that the views and the opinions and the analysis expressed here is my personal analysis and my personal opinions, and any decisions by the viewers regarding based on this analysis is requested to do their own due diligence and research before acting on this, as I am no way responsible for their investment or the decisions. So as you know, let's start. So you know that a lot of in last 1.5 months, particularly 2 months post this conflict, Russia-Ukraine conflict has started, the markets and the world overall has been in a very bad turmoil, and as I keep on repeating that the economy is, particularly the big country like Russia, it is integrated economy with the world, and definitely if something happens here and these sanctions and all these effects, so it will not be every action has a equal and opposite reaction. Yeah, right, Newton's third law. So in the same way, if something happens with in Russia, so it's not going to, the other countries are not going to remain unaffected. The world is not going to remain unaffected. And we already seen the impact, very bad impact of that. But I would just like to, before going ahead with this forecasting about what is going to happen in this year and how one should, what one should do, I would just like to give a little bit background regarding the GDP and the concept of GDP, per capita GDP, what is that, what does that mean, and the growth rates, and also the debt, the government debt of each countries, or some few major countries I would be talking about. So to give an idea about what is actually what when the so-called analysts and economists all over the world tom about, say, GDP slowing down and recession and all these things. So what is the actual impact on that? So let's start with the USA. So USA is, as of the latest, the data of whatever, December or whatever, you can say that it's a yearly GDP is around $21 trillion. Okay, $21 trillion. So if you, taking the USA population consensus into account, and if you divide it by this population, this GDP, you get the per capita GDP. That is what the per person, what is the contribution, or what is the production or productivity of each, or what is the value you put on in per person in that country. Value of a person, average value of a person in that particular country. That is what GDP per capita. So it's around $58,000, $59,000. Okay, per person. So the value of per person in USA is around $58,000 to $59,000. So that is what it is. Now look at this, the debt. So actually USA government has 130% debt, 140%, means whatever the GDP, they have taken even much more money than what is they can, why they have taken, or why it has been so much, because it is acts as a reserve currency, main reserve currency in the world. So that way of that safe haven asset, what you called. So people keep on buying US bonds and US, that's how all the countries also invest into this US bond. And that US bond, basically it's a USA government taking debt from you, which they have to repay. So you can imagine if at a time when everybody, the whole world or whatever the other countries, they start encashing or they start selling this debt, what can happen to the US dollar, or what can happen to the bond market, and what can happen to the financial world system. So that is one. Second is Euro area. So Eurozone, if you take, so it's around $13 trillion of the economy, the GDP of Euro area. So if you take the Euro area GDP per capita GDP, with the population. It's around $35,000, $35,000 per annum. So that is the value of a person in euro, you can say in layman's language, okay. And also what is the debt which the euro government as a government has taken. So euro is also a kind of a reserve currency like USA. So they also issue this bonds and everything, and all over the world that whatever that investment happens in that euro bond, that is basically the debt by euro. So it's around 98%, you can say, whatever that you have seen the GDP 13 trillion, so it's around 98%, means around $12 trillion is the debt. So it is a debt driven economy or debt driven growth. I'm not talking about growth, because growth is a let's say it's important, but it is important for the stock market. I will explain it to you little later. So now come to China. So what is the GDP of China? It's around 14.5 trillion, means around $15 trillion GDP per annum. This is, we are all talking about per annum. So taking into account the population of China, what is the GDP per capita? It's around $10,000, $11,000, okay, per year. So that is the value of a person in China, okay. That is the value, what you can say. And debt is around 64-65% of the GDP is the government debt. Means it is the government, because we are not talking about the corporate debts. Just individual companies can take debt in the foreign currency. That is not considered as a, we have to look into the account of the government debt. So how much is the government debt? Because that only gives the idea about how much government can sustain in case of, something crashes like what happened in Sri Lanka. So Sri Lanka was 100% on it's a small country, small GDP, and the government debt was 100% of GDP. And that is why what you see, the kind of situation happened. Because of that only default and everything crash happened. So that is, this government debt percentage to GDP is very important figure. That is what you have to take into account. So it's around 64-65% of the China GDP is by this government debt. Okay, so you can say it's also a very highly debt leveraged country. Now come to India. So what is India's GDP? India's GDP as of the latest figure was around $2.7 trillion. Okay, on this last December. So $2.7 trillion per year. And what is the per capita GDP comes to? Around $2,000. Roughly, approximately around $2,000 per person, per capita GDP. So that is the value of an Indian in India. Of a person in India is around $2,000 only per year. Okay. This is very important figure. So you can see what I am trying to give you is a comparative example. That GDP growth, when we talk about that high GDP growth, why it is important for this country like particularly poor or the developing country like India. So in comparison to China, we are less than 6 times. China is 6 times bigger in economy, GDP, per capita GDP, everything. So to reach even to the level of China, even if they talk about 10% is never going to happen. We are going to grow around say 7 to 8%. Even that is doubt this year and next year, which I believe it's, because of the situation which we will discuss. So you may take something like, for doubling your roughly around 10 years to double. So to reach to that and then to reach to the China's level, you need around 25 years to reach to the what is China at current present level of GDP or economy. 20 to 25 years will take, not less than that. Now come to Russia. So what is Russia's GDP? Russia's GDP is, as of the latest figure, as of that last year's was around $1.6 trillion. Okay, $1.6 trillion, less than India. But what is the per capita GDP? That is where, population and, you divide it. Then it's around $12,000 per capita. So even it is higher than China's or equal to China kind of, $12,000, $13,000 per capita GDP. So the value of a person in Russian is $12,000 to $13,000 per, yeah, this is. So now let us talk about that. Even if when they tell that the GDP decline and recession will happen, and India is growing at a great rate, but as I told you that even if India grows at 7 to 8% rate, it will take around 20 to 25 years to reach where China is today in terms of the GDP, not less than that. And constantly to grow around 7 to 8% also maybe it's difficult, because like what happened in this year, sudden event like this war kind of situation and all over the tension. And also we are not talking about this China Taiwan, which may suddenly happen also, that conflict. So in India also can have a problem with China on LAC and LOC. So what we are trying to tell is that the per capita GDP. So when they talk about all this economists and everybody that Russia is going to be in recession and great decline, already around 11% in last quarter they declined because of this conflict war kind of situation. So even if you take that how much Russia will, and the important point I forgot about is that India's GDP, India's government debt is 75 to 76% of the GDP. So majority debt India which has, it's around $600-700 billion of debt, which is mostly it is external debt which India has to pay to the outside world. Okay, it is 75%, 76% of the GDP India is holding the debt. And you look at Russia's government debt to GDP, it's only around 17%. It's only around $38 billion. Total is around $200 billion of external debt. But government debt is only around 38 to $40 billion at max. That's what roughly. So it's only 17% of the GDP. So technically when you talk about it, and it's a trade surplus because it's an export-oriented economy, energy and resource-oriented economy. So that is why it is always into the trade surplus. So now look at this, that even when they call about the so-called technical default, because it's technically, because per se Russia has not said that I am not paying. I am paying in rubles. You open a ruble account and you convert it into your currency of dollar or whatever. So it is called technical default because that is what the word is used, but it is not actually. So look at this now, that Russia can even afford to even that recession happens. It looks like it will happen because not recession only, it's a negative growth, a heavy significant negative degrowth of 10 to 11% in this year. Russia's economy can go down. So even if you per capita, if you convert it into, so it will go down by say $300 or $400, around $500 per capita loss of GDP per capita will be in terms of the per capita GDP in a year. But at the same time, you look at the Eurozone, even Eurozone is not going to grow. I mean, you look at the latest figures, it's around 0.2%, and now they are talking about European Union that it may not even grow by 0.2%. I mean, you may have the 0% growth or negative also. It's like, it may not be significant negative, but even if say minus 0.5%, it's a minus 0.5%. It's also a big loss for Europe, and you convert it into the per capita. So it will be almost of the same type of value loss for Eurozone per capita. Okay, $500-600 loss per capita GDP. So what I am trying to tell is that even if that this is $11,000, $12,000 per capita, $500. So and look at the India's, it's only $2,000 per capita GDP. So it's much poorer country compared to say Russia, China, Europe, or majority of these countries. So the absolute amount of GDP is big and India is growing really, that is no doubt about it. But if you look into the per capita GDP, which translate into the overall development in the sense that the overall security of the people, health of the people, or prosperity of the people, richness of this thing, it is still much behind, and it has to grow at a very high rate to reach to this level. So even if the Russia goes down, and this is a year of a negative minus 10-11% degrowth in the economy happens, but still Russia will survive. Economy may suffer, and as we told, but still Russia will survive. As you know, that per capita GDP, that value of the people is much higher. So that way, even if it's a much rich country, so they have much more. What is the per capita GDP? Is that they have much more resources, the government or that country has, to spend on the people, and for the development of the country's economy, infrastructure, and overall to support people's health, to support people's services, to support its requirements of the public. This is for this higher GDP, or the higher per capita GDP helps into disposable income. It's called disposable income, which can be spent on the welfare and the prosperity of the people, on increasing that. So that is the key metric, per capita GDP. And now coming back to why I gave you all this thing is that, as I told you, that technical default and all these things, and India growing at 8%, 9%, all this only, if you look at the per capita, so still India has a long way to grow. That is why if it grows, it's very good. It is very important for India to grow. But still, India is not in that league to, exert or that much of an influence on any of the major countries economically, or say that way, because economy plays a big role in shaping your foreign policy, and in shaping your whom you want to cooperate with and whom you want to be adversary. So that is why this GDP for India matters a lot, GDP growth. But for other countries, maybe even if they talk about that China may be growing less than 4% and 5%, it's a $15 trillion economy. Doesn't matter. I mean, even if it grows at 3%, still it's huge. Such a huge base is there. Its absolute number itself is so huge. So that euro also, going down, its absolute number is huge, $13 trillion. USA also, $20 trillion economy, GDP. If it is, even if it is, slows down and recession and all this thing, but still it will, yes. But the only issue is that the people at certain comfort level, when you reach at that, you don't want to accept even little less than that. That is where all this is a mental psychological makeup comes up. So going forward, because of this prolonged Russia-Ukraine conflict, which in my opinion is that it's not going to be solved very simply, as if it's not going to close. Even if there may be some kind of a negotiation in next 1 month or so, and some kind of a, the stop it will look. But I believe that the way the geopolitics is shaping in this world, we may have a situation where economically huge suffering will happen after 2-3 months, means after summer. Why I am telling like this way? Because there is agriculturally that sowing and everything has not happened in Russia, I mean in Ukraine basically, and also in Russia less, and Europe and Africa basically, which depends on this grains and agriculture product from Russia, Ukraine basically, they will suffer, because after the summer, when the new crop supposed to come and the new supply supposed to come, that will not, it will be very less, and that is where the inflationary pressure will be much more, and that is where the pressure on the economy will be felt, and that is where also the conflict can again arise. This kind of, because of this kind of destabilization, Europe will continue to be in the boil on one front, with this domestic this economic problem because of this high inflation and less food product available from this, and high energy prices, and also because of that as Africa will be suffering. This is my understanding, analysis is that Africa will also, there will be a huge crisis, food crisis in Africa, particularly poor countries, that Africa, Latin America. So you may see a huge influx of refugees going from Africa to Europe. Again, that wave of refugees which we had seen some 3-4 years before, uh, it may again happen. And so that way, Europe may be fighting on multi fronts with this refugee crisis, millions of refugees suddenly pouring into Europe, its own domestic economy slowing down, inflation and high prices. Already that sentiments of the public may be on the boil against the existing kind of a system and government. And so you may see this kind of a conflict or the boiling happening in Europe, and Europe's economy may further decline. And that is why I had come out with last week about that euro currency, why it's going to weaken. So this kind of a instability is going to remain in the full year, which I believe this is going to keep the commodity prices on the boil, on the high continuously for this year. I don't see that it is going to, whether it is energy, whether it is agriculture commodities, whether it is metal commodities, physical commodities, most of these commodities. And because of this kind of inflationary pressure and all this world connected, as I explained to you, that how the GDP, even if the little decline for India and the inflationary pressure high for India, the stock market all over the world, I don't see that it may perform any good. So it doesn't make any sense to invest. I would continue to stay away from the stock market in this year. In fact, it would be better, even if any rise I see, I would sell and try to keep in cash. Because like I tell you in an example, say in Europe and in USA and in India, the inflation is say around 6, 7, 8%. Actually, inflation is around 7, 8%. And in USA you get what in the bank account or in the bond, maybe 0.25% or maybe 0.5% or 1%, maybe, if they keep on increasing these interest rates. In Europe also the same thing, around 0.5%, 0.5, 50 basis points it's called. In India, in the bank account, how much you get? It's around 6% maximum, if I am not wrong. So all these figures are less than the inflation figures. So it doesn't make sense to keep money into the bank. Also doesn't make sense money to keep into the market. Market is going to, I don't think so, is going to. So better to have cash or in some physical commodities. As I told you, all these commodities and energy are going to be on the boil and on the high, continue to remain this year. So they will do well. Those kind of companies, energy companies, which has their own mines or own resources, resource companies will do well. The agricultural commodities, the agricultural companies, those, kind of, if you have, it will do well. So this is what I just wanted to share my thought about way ahead regarding economy and markets in the rest of the year post this conflict. So we'll see you once again next week with some another unique and concept and ideas. Till that time, ciao from Neeraj from Moscow, and love you all.